So today we are starting with our lecture on the statement of cash flows. And in this lecture today, we are going to be looking at the introduction to the statement of cash flows. But then remember that I've always mentioned that when we talk about the statement of cash flows, we are talking about the financial statement that is prepared showing the cash inflows and outflows arising from a reporting entity. In this lecture today, we will specifically be looking at the statements of cash flows from the perspective of IAS 7 statements of cash flows. IAS 7 is the financial reporting standard that guides the preparation of the statement of cash flows i- in the financial statements of a reporting entity. One of the objectives of IAS 7 is to provide information on changes in cash and cash equivalents of a reporting entity. So, what do we mean by cash and cash equivalents of a reporting entity? By cash and cash equivalents, we are talking about cash in hand and short term demand deposits. Those short term demand deposits include short term highly liquid investments that will not result in significant changes in value when liquidated. Also, IAS 7 prescribes that a reporting entity classifies cash flows into operating, investing, and financing activities. Also, the standard helps to assess a reporting entity's liquidity, solvency, and ability to generate cash. In IAS 7, there are three cash flow classifications. The first is operating activities, which is followed by investing activities and financing activities. Under operating activities, we present principal revenue generating activities. Under investing activities, a reporting entity presents activities related to the acquisition and disposal of long-term assets. And lastly, under financing activities, a reporting entity records or presents changes in equity and borrowings. Now, it is important to note that in a statement of cash flows, these three activities must be presented in the order in which they have been presented here. And then it is also important to note that we have a set of cash flows, cash flow presentation as prescribed by IAS 7. And this is shown in this current window where we have cash from operating activities as X, cash used in or obtained from investing activities as X, then cash paid or received in financing activities as X. The summation of the three will give us net cash inflow or outflow during the period. And to this amount, we are going to add the cash and cash equivalents at the beginning of the period, as then we will now finally get the cash and cash equivalents at the end of the period. So back to the statement of cash flows in line with IAS 7. I've presented the a simple format showing you how the statement of cash flows is prepared. And we said that you add up cash from operating activities to the cash flows used in investing activities and cash flows from financing activities to get the net cash inflows during the period. We add to the net cash flows inflows during the period the cash and cash equivalents at the beginning of the period, and the resulting figure is the cash and cash equivalents at the end of the reporting period. Now, we are now moving into another aspect of the statement of cash flows. And in this second aspect, we want to see examples of operating activities, investing activities, and financing activities. So, what are examples of operating activities in the statement of cash flows? Here we have cash received from customers, and then we have cash paid to suppliers. We also have cash paid to and on behalf of employees. We have interest paid. These are examples of operating activities. Note that the cash receipts are inflows while the cash payments are deemed to be outflows. Then we have operating activities that are controversial depending on the nature of a business entity. When we talk about controversial operating activities, these activities are controversial because in one way or the other they differ among they differ among several business entities. For instance, if a business entity is a bank, there are certain operating activities that are peculiar to the banking sector. On the other hand, if a business entity is a manufacturing organization, there are also operating activities that are peculiar to that entity that is a manufacturing enterprise. Now, let us take an example of what I'm saying. For instance, if a bank gives out loan to customers, then that loan that the bank has given out to customers is an operating activity, because from the loan given to customers, customers will be expected to repay the loan with interest. And in repaying the loans given to customers with interest, customers will be expected to pay timely. So it's a form of a product that the bank is selling. That is, the loan issued by banks is a form of a loan that the bank is selling to customers. What that means is that if if a company or if a reporting entity is not a bank, then it means that if that entity makes interest payments, then we can treat the interest payments made by the entity as either an operating cash flow, because they are deducted when calculating operating profit before tax, or they can also be treated as a financing cash flow because they are cost of obtaining finance. What this also means is that the nature of the business is a pointer to how we classify activities or line items in the statement of cash flow. Another controversial item is interest received. Interest received is treated as part of profit or loss for financial institutions such as banks. And the rationale for this is that banks earn interest and receive interest as part of their revenue generating activities. For example, banks receive interest on customer loans. So for banks, interest received is going to be treated as an operating activity. But for any other type of business that is not a bank, interest received is treated as income from financing activities, from investing activities, because we say that the reporting entity has invested in the financial instruments of other entities, and such interest is received from the bonds of other entities. For instance, if a manufacturing company receives interest on fixed deposits. Examples of investing activities include purchase or sale of property, plant and equipment, proceeds from financial instruments, loans to third parties, cash received from repayment of loans made by third parties other than those received from customers or financial institutions. Also, loans issued by financial institutions is an operating activity, like I said earlier on. Remember that when we talk about purchase or sale of property, plant and equipment, property, plant and equipment are non-current assets in the statement of financial position of a reporting entity. And as non-current assets, these assets are expected to yield or to lead to future economic benefits to the reporting entity. What this implies is that Reporting entity is expected to purchase property, plant, and equipment because they believe that such purchase is going to lead to future economic benefits to them in the long run. This is why we say that they are investing activities. Also, financial instruments that are not short-term demand deposits are also investing activities, because as long as these are financial instruments of other reporting entities, then this kind of financial instruments are investing activities. Let us now look at the next very important item in this lecture. In this lecture today, we are also going to give examples of financing activities. Examples of financing activities include proceeds from issue of shares, proceeds from issue of loans or loan notes or debt, loan repayments in cash, dividends paid, cash payments to owners to acquire or redeem the entity's shares. All these are financing activities, and usually when we talk about proceeds from issue of shares, we say that when an initial public offer is made to prospective investors, the reporting entity that has made the initial public offer expects to receive cash from those prospective investors. So that is an example of a cash inflow to the reporting entity. Also, when a reporting entity issues loan notes or debt instruments to prospective shareholders, when these prospective shareholders subscribe to the debt instruments, the reporting entity receives cash, and that is also a form of cash inflow arising from financing activities. Let us note that it is very important that a reporting